Yelp being downgraded to a sell at Aegis Capital. That firm cutting its estimates and lowering its price target to $34 a share. Yelp shares are, no surprise, under some pressure in today's session, but the stock is still up nearly 35% over the past 12 months. Sarat, you own this one?
I do, and it's actually down 20% from its peak, about 48 to about $40 now. This is kind of how we look at it. I mean, the analyst is looking very short term. What Yelp did was a fundamental change to their business structure. They went from long-term contracts to no contracts. They had been testing this for 2 years, and what they found with their current clients, nothing had changed. But they were able to get more customers who were trying it on a trial basis. Now, I understand that in the short term, customers might churn more because they try it and man, I like it, and some might stick around. But if you look at Facebook, you look at Google, none of them have long-term contracts, and Yelp, in their I guess, and what we support is they're looking longer term to say this is kind of how we think we're going to grow our business. They also have other levers like request a quote. If you look at the stock on a valuation basis, it's a $40 stock with $9 in cash. So we're not looking at a company that's spending money but borrowing to do it. They are cash flow positive, and they've actually been growing margins. So look, it could digest for the next couple of quarters, but I think I would like to own this company for the next couple of years.
So is this a stock that should have never been at $101 like it was in 2014?
Exactly. I mean, I think people got very excited on a stock like this until they prove themselves, then you get the multiple compression. But you know, they just did a deal with Grubhub. They're in the right places, and they're a small company. They're a $3 billion market cap. So they are growing, and today I want to buy companies that are spending money to grow, but are making money along the way, and not just saying we're buying eyeballs, we're buying users. We're actually getting customers, but longer term, I think it's the right model.
Are they an M&A takeout target? Sorry.
I wouldn't buy it for that reason, but when you look at their balance sheet, absolutely. Because somebody else could come in, an IAC or somebody else, and say, hey, you're in kind of the areas we want to be. We could monetize this, and it could actually be accretive. But I wouldn't buy it for that reason.
So there are two ways to always look at something like this. Either it's a defensive move that the company's matured, and that now they're looking to, they've matured as well as being defensive, or they see that it's another growth opportunity. Since I've been in the business, subscription models have always been worth more, and they're going away from a subscription model to basically a ready access model, but you can't compare them to Google and Facebook in my view, because those have significant moats around their businesses. I don't think that this does.
So I would disagree with you, because Yelp users go back to Yelp and they have recurring revenue on that side. What they were hearing from their customers were saying, look, we don't want to get into long-term contracts. We want to use it. They did not have a fall off with the current customers. This was a way for them to grow to other customers.
But why wouldn't you offer those long-term contracts at a discount like every other subscription service does? You sign up for 6 months or a year, you get X price. You go monthly, you pay more. So there's optionality in everything.
But they are growing their business. They just hired more salespeople. They want to touch more customers and want to give them a try. So in this way, you're trying it, yes, at a lower revenue, but you have a much bigger total addressable market.
So then I think you added too soon, because the additional costs are going to overwhelm any near-term growth as they transition.
But they are still positive earnings, and they're actually going to grow their margins.
Right.
But what about user engagement?
Last word.
Okay, just the user engagement, because that's what he talks about in the note.
So user engagement from new customers that are churning, yes, but older customers, not. They are still actually actively involved.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.